Welcome to Trading with Livevol. For those of you guys who've been following me, you guys know that I'm trading with Livevol X, and I'm using my own Reg T trading account. And you guys can follow my trading every day, and then as well as how I arrive at these trading ideas, why I execute them, and what the results are. So let's actually see today. Looks like I'm down about $625 for the day. Most of it in this Yahoo. I'm just long calls. I'll see how it goes. I want to talk about this OUTR trade that I just did. Let me actually go to that stock because I think it's very interesting. So I basically sold the July 65.55 put spread for $350. Let me see. Let me actually see this thing. Yeah, you see I sold it for $6 and bought it for $250. Now, just to give you guys a quick little background, there's a Dutch tender offer going on in Outerwall. For those of you guys who do not know Outerwall, they do have those red box where you like rent the movies. Well, anyway, they have a pretty activist investor who's been kind of bugging them of trying to maximize the shareholder value. Basically, the agreement that they came to was that Outerwall will purchase up to 20% of their shares back between 66.82 and 76.32. And the deadline to actually do the tender offer is March 7th. So for those of you guys who say, what the hell is this? This kind of play used to be one of my favorite kind of things to do on the floor. So what happens is as soon as these guys announce it, what I try to do is I try to do a conversion reversal. So basically what I'm trying to do is I'm trying to sell the calls, buy stock, and buy put. So I'm trying to convert. What I'm trying to do is I'm going to load up on stock. So for example, you see like right here when they made the announcement, stock was trading around 63. Basically they make the announcement and you can see on this left hand side stock's trading around $71, right? So around $71. As soon as they announce it, I'm doing a conversion reversal. So it's basically a banking function, but basically I have my P&L line is flat. I'm buying puts, buying stock, and selling calls. But what I do is I buy extra shares. So instead of buying 1-to-1-to-1, I actually buy more shares than I have, knowing that I can tender and up to 20% of my stock will be taken away. So I do this, and then if the stock goes up, you see how like the stock went up to 73 bucks? You can actually just sell stock, and then you can basically not tender any shares, and you just make $2 on the stock, right? So it's one of the favorite plays. That is the general play. There is very, very many nuances to it, and if you played it, there's many different ways you can do it. The way, so I was reading this and going like, okay, well, how am I gonna play this as with a retail account? Because it's not like I can convert and get long like 50,000 shares, buy another 10,000 on top of it, and then tender my 60,000 and try to make my money that way. So the thing I came to was if this company was willing to pay $65, 66 to take away 20% of the float, I'm thinking that's a pretty good bottom. Also, I'm not that intricately familiar with the fundamentals of this company, but let's just say this company was trading around 63 bucks. If you take away 20% of the float, basically roughly that would make the company worth 74 without actually having to, with the same PE ratio. So just by the fact that you eliminate shares outstanding, you make your company more valuable using the same exact PE ratio. Kind of like what Apple is doing what Icon is suggesting Apple to do. So OUTR is actually doing it. They're eliminating 20% or up to 20%, and that's what they did. So I've been, since this day, I have been trying to sell this put spread. Now, originally I wanted to sell the August 65.60 put spread, but it just never panned out. I never got the fill. But today, I put in this offer, the July 65.55 put spread, and I put it at 350. So the thinking behind it is I'll sell it for 350. It's a $10 spread, and I receive 350. So it'll take up $650 of margin. And if outer wall does not go below 65 or 65 or higher by end of July expiration, I should make roughly 3% return on my money in 4 months. So that's the simple version of why I'm doing it. A lot of times, these stocks, after they do the tender offer, they tend to run. So one of the other things I'm working on is I'm trying to do this spread, right? I'm actually trying to buy the April 75 calls and sell the March 75 calls. And you see me working that right here. Right here, boom. Let me put it up, right? The fair value is 65. I have a 70 bid in to buy 4. If I get filled, I might do more. So usually I kind of dabble, and then if I like it, I want to do more. So you see how this outer wall spread, I sold 2 at 350, but after thinking about it, I liked it, so I want to do more. So I'm putting it at 380, see maybe if I can get filled. So after today, after midnight, tomorrow, like Monday morning, you'll come in, and then people say how much of the shares got tendered, what percentage got taken out for what price, and depending on what that result is, the stock will have some kind of movement afterwards. Usually, the stock runs up. So as you guys know, I like to buy options, but I don't want to just buy them naked. So I put the spread on, and hopefully I can get this for 70 cents. And my premise is that for the next couple of weeks, it won't reach 75, or will only reach 75, and then it'll go higher afterwards. And I would be willing to pay 70 cents. I think it's a really good trade if you can get those two combo off. I'm not sure if I can get the call spread. I would like to do it, but I'm just not sure if I can get it. Hopefully I do, and then that would be great. So for those of you guys watching this, to summarize, I did this because they have a Dutch tender offer. They're going to eliminate up to 20% of the float. The lowest price they're going to pay is around 66.82. Highest is like 76.32. And the premise is that if the company is willing to buy 20% of their float for $66.82, most likely they feel pretty confident that it's gonna do well. They also had like some kind of investor meeting conference, and it looks like whatever they said, and I didn't even listen to it, but it looks like whatever they said was pretty decent, and then it started selling off. This sell-off probably is coming directly due to the fact that the Dutch tender is going. So why is it selling off? Well, if I thought that the takeout, the Dutch tender price that's going to be taken out is lower than whatever my current stock price is. So let's say you were okay with selling the stock at 73 and that's what you wanted to tender your stock for, well then you can just go out to the open market and sell it, right? So what's happening is everyone started selling and now it's gaining momentum. So everyone is selling, and we'll see where the bottom is. So you see the tick chart, it's like, you know, everyone who owns this stock is like, yeah, I'm going to sell. And then when they tender, whoever is left, they have to tender it most likely for higher than wherever the stock is closing, because otherwise you could have just gone out and sold it for that price. Or you're hoping that all these selling would eliminate people from tendering, which means that there'll be less stocks tendered, which will drive the stock price up of the tender. So it's pretty interesting. It's something that I used to enjoy and do a lot of, and you can make a ton of money doing this, and you can also lose a lot. So, for example, let's say I did it you know, let's say I bought 50,000, I did, you know, was it like 500 conversions, and I got long 50,000 shares, and I bought an additional 10,000 right here, and let's just say I thought it was the top, and I sold it, I would have made 20,000 just on scalping the stock, and basically, you know, I wouldn't tender or do anything, and I would be okay. I would just tender it higher. So like I would actually, stocks down here, I might buy some more shares now that it's down here, and then I'll tender it for a higher price and hope that I get some of it for a higher price, and then I scalp it that way as well. So that's out of wall. I sold the put spread, and I'm trying to do more of the calls. Another interesting stock that came up is, I know I'm always reviewing trades that I did do, but these are stuff that I'm thinking what I would like to do. You see this SKUL Candy. They had some really good earnings today. I think they, I didn't read in detail, but basically they earned 13 cents and they were expecting 9 cents. But you see like this huge spike and then it came back down. Let me actually go to this chart right here. Type it in. Yeah, yes, you see, so how this had this huge spike up, and this is the daily. Let me actually go to weekly, see if that's actually better. So this is the weekly stock chart, right? And this is the Bollinger Band. You see how the Bollinger Band is widening because of today's action. But if you look at the stock, it doesn't really trade that far out of the Bollinger Band on a weekly basis, which is why when it probably went to 1140 this morning, there were a bunch of sellers, because just technically it's not a, it's so far away from the averages of all these lines that people use for technical trading that it's virtually impossible, you know, unless there's like a massive short squeeze, and I don't think there is as much short float. But my general thinking is, you see how like this pattern is on an upswing. I'm kind of bullish in the short term, but I would like the stock to be around 9, ideally, to put on this trade, because it's actually would be at the top range of the band, right? So what am I thinking? Well, one is this volatility. So after earnings, usually the volatility takes a nosedive. You see how like this volatility right here after earnings, if you look at the IV 30, it went from 70 to 48, and it's right here in this box. So it went to 70. You see the red IV 30, 70 to 48, right? That's a pretty massive decline. Like here, you only had like a 6% decline when normally you go down like 40%, and it's probably because this huge move in stock, right? So it's actually a good time to sell some vol. Now, normally, I would actually go in and maybe buy stock and do a buy right? Like, because, you know, let's say the stock goes down to 9, and then I start selling some calls, let's say these, right? These are like 66, 67 vol. I sell this, I buy it for 9. Basically, I have, you know, I have downside of $1 risk, and I can make $1 on the stock, and I can make $1 on the option. So I can make $2 at risk $1, or, you know, in my mind, I'm only risking $1 because if you buy stock, you don't think it's going to go below 8, right? So that's kind of what your mindset is when you're putting it on, and that's how you can do a lot of plays and you can make a ton of money. My feeling is, I think this stock, you see how like in middle of December it was trading 550, and even with this pullback, right, it went up $2 like within 2-3 months. So I can kind of see the stock like trading like, you know, who knows, like $12-13 in 2 to 3 months. So I think like a call spread is what I was thinking of. I just don't know which one. So if this thing goes lower, and I don't know if I'm going to put it on today, I'll probably wait until sometime next week. But what I'm thinking is, if this stock hits back to the lower end of the Bollinger Band, so let's say this thing, you see how this tick chart keeps like dropping down? Let's say it goes down to $9. At $9, I think I might be willing to take a shot and do a spread. So I might buy like these June 9s and sell these, the the 12s. And the reason I picked the 12s is you see how like 1,000 of these traded, and originally when the stock went up, people are buying all these calls. So they actually were buying these calls right at the onset, but what they probably didn't realize was that was the top, right? So they bought all these calls, but I don't think they bought it. They probably thought it was going to go higher. So I kind of think like maybe that's where the line might be good to sell, because all these guys who are buying, maybe that's usually the time when they're going to be hedging their positions and stuff like that. So there's probably going to be some interest on this 12 line. So I'm thinking like 9, 12. Let's see what that spread is right now. 9, 12. Yeah, so it looks like it's about $1.10. So you know, $1.15, and you can make max of 3. So you know, you can make about 250. What is it? This is a $3 spread. So you can make 150% return in 4 months if it works out. But right now, the fair value would make it 10.15. So as you guys know, I kind of would like to make money if the stock doesn't go up, and make the money if the stock does go up. So maybe I don't know. I don't really know exactly what to do. Probably I'll think about it over the weekend, but I would like to do some spread because the vol is high still. It's only down 7%. And when the stock settles, I'll kind of know where the next stock target is. It'll probably be 11.40. So this stock might actually have a decent chance of hitting 11.40 sometime soon. You see how this monthly is a beautiful round shape? So it could easily hit $13 in my opinion. So I want to do some kind of spread, but I want to do it at the right time. So I really like this trade. I was looking at it, and I came to it because I write the blog as well for the Fidelity. If you guys are Fidelity clients, I actually write the blog over there, the options. And I was looking for stuff to do. Oh, there's more stuff at Charter. So I'll get to that in a minute. I just got executed. So I just got filled, I mean. And so I'm gonna figure out a way to take advantage of this curvature going up, and people are still buying. So I wouldn't really put this trade on, but it looks like generally people are bullish on this stock. You know, I'll do more reading over the weekend. If I change my mind, I'll let you guys know. But they just, you know, blew away their earnings. I've listened to one of their headphones before. It's pretty good. I'm not sure if they're like that much more spectacular than somebody else, but I do know they're a lot cheaper than like getting Beats, right, or JBL headphones and stuff like that. So I'll see how that goes. So there's 2 stocks right there that I haven't done anything, or I just started doing, but I have interest in. Another one is Safeway. So this Safeway, they just announced that they're gonna sell the company, right? So they're gonna take it private. Apparently it wasn't as high as people were expecting, so the stock took a little dive. And the volatility, you see this volatility, this is the key factor. It's like super low. So what happens when these kind of deals come into fruition, and is that I always like to just go in there and try to pick up some cheap options, right? So what I'm bidding on is this. Oh, so you see how this is 150? Let me actually show you my ticket. The Safeway. I was actually bidding 135, which was a nickel higher than the best bid. So I was actually nickeling the best bid, and I was the best bid, but now I'm not, and it looks like people are paying 175, 190. The reason these are so powerful is for whatever reason, if something just blows up, you see how this implied volatility is 11? I mean, it's really low, and if you look at the chart, let me actually punch in 360-day. The 2-year volatility on the average is right around 30. So this is a third of what that volatility is trading. If for whatever reason the deal doesn't go through, for whatever reason, you basically could make tremendous amount of money just because of the volatility going up, even if the stock goes up. So every time there's this announcement, it's worthwhile to look at it and start putting in some bids. If you get filled, you can probably sell until the deal is done, these other calls, puts against it to offset your costs. And you would more than make that up throughout the course of the time when this deal gets settled. So I put in the bid. I'll see what happens. You know, maybe I'll do this. You see this 35? I'm actually gonna do a 45 bits. I'm gonna actually nickel that market, see if mine takes. Right. So I'm a nickel bid. So I'm the best bid right now, and hopefully I get filled. If I get filled, it's great, because you see how like already people were paying 50 cents for these, and I can sell others. So the 35s, I can probably sell some of the other puts to offset it. Chances are I won't get filled, but we'll see what happens. Looks like I just got to fill. The next stock is this Charter. So you see how I just got to fill in Charter? I was talking about Charter yesterday, and what I didn't like was that this spread was too wide for me, the 25-110, and the risk parameters was that, you know, I would make like 325, but I can lose 12 or 1150 or 1175 in return. So I wanted to narrow this gap. So I was trying to do it for 50 cents and 55, and today I put in a 60 bid. So basically what I did was I sold this spread for 325, and then I bought this spread back for 60. So, you know, I'll probably have 260. The most I can make is 260 on this 125, 120 put spread, and the most I can lose is 240. And that kind of parameters is okay, because now, you know, you see Charter, it's 26.90. And as you guys know, I still think maybe it's not completely over. Maybe Charter gets time to think about it, and they might possibly make another bid. Or just generally, I think, you know, it's kind of like it got hit because they didn't make the bid, but they didn't make the bid down here either last June or like here in July, and the stock's gotten hit that way, and maybe I think it's on an uptrend. So I bought a call too, but that was kind of on a shot, so it doesn't really, you know, I kind of regret buying it, but in the end, like, I'm with it. So I manage this and see how it goes. Let me cover EEM. So I was doing the strangle in EEM because I saw the video on SuperTrader, Karen the SuperTrader, and so I sold these calls, and yesterday they went in the money, and I explained in detail why I didn't buy these back was because there was this whole slew of sellers here, right? So this is where, again, the software, I don't know how people trade without this, because otherwise you would have had to just make a decision blind, right? If you knew that everyone came in and started selling these in block trades, so let me see if I can actually pull that up. So this is today. So you see today, most of the trades are red, which means they've been selling, right? But I can actually go back a day. Let me actually go back to yesterday. So you can actually go back 2 years. So for those of you guys who love back testing, but you see, like, in the morning, 10,000 of these traded for 57, 58 cents, which made me a lot more comfortable not having to buy these back and keeping them short, right? Not only that, it hit some resistance level. So there was like 2 factors why I left it. Now the question is, how should I roll this? Because I think I'm supposed to roll it, right? So I have these for 21 cents, and I did the 30 delta last time, and that kind of came back to it was risky, right? So, you know, the question is, should I sell these, the 40 and a half, against it? I'm not sure. right now. But maybe I'll try. So I'm gonna buy these. So here you go, guys. I'm actually doing the decision right now. And I'm gonna sell these, which are about 27 delta. Right, so I'm gonna roll into the next one because I made some money, right? So okay, what did I do? I'm gonna buy these back and sell it, and I need 6 cents credit. So I'm gonna do it for 6 cents. Is the stock gonna go down? Let me see. So it basically, if it goes down, I should put in a bid that's a little bit out. If I think it's gonna start meandering and going back up, I should just hit the bid, right? So I'm gonna put 6 cents, which is the fair value. I'm gonna send the order. Boom. So we'll see what happens. So I'm gonna try to roll the puts. I'll see how the puts go. Let me see. Right, so the puts are here. I'm not sure when I can roll these, but I'll see. I'll just leave it. If EEM goes down further, I think that's when I'm going to roll, because I'm going to look at these independently, the calls and the puts, and not roll them together. At least according to Karen, that's what she was doing. So still at the experimental stage. You know, I did notice something while I was prepping up for this, that Apple is now below 230 again. So let me actually type in Apple. So remember, I did the, you know, 510, 530 call spread. You guys know why, but let's see what that value is right now. So I'm going to do complex. Buy. Oops. I'm gonna sell buy. Basically, it's 12. It's still 12 bits. I bought it for like 11 or 11.50, you know, it's still higher. So, you know, I think it's pretty good trade. Now, I would really like to put some more on. Let me actually see the chart here. See, I don't like the daily or the weekly on this chart, but I do like the monthly, which is why I kind of thought in the long run it would actually, see how this is the monthly. You see how like it's tightening up, and basically your bet is after it kind of tightens the trading range, where's it going to break out to? Is it to the upside and downside? And I think it's going to break out to the upside. That's what my premise is, and that's why I'm doing these trades. Not only because of myself, but because probably all the other experts are in it. I look at the calls and puts. Basically, it's pretty even. They're a little bit short premium, and they're selling delta. But there's nothing here that's unusual. Maybe I can do lower. So the thing I've been working on or trying to get filled is like a strike lower. So yeah, this is 128. So maybe I'll do this spread. So I do complex. Let me clear this out. I want to buy the 505s and sell the 125. So I'm basically, you know, doubling up the call spread, but I'm going down a bit, right? So I think maybe 12 bucks. 12 bucks, and I'll make 40% return. You know, maybe I'll go further out. So for those of you guys who are thinking sometimes like that, I know everything exactly. I really don't know. I just kind of like, I'm doing exactly the same thing I'm doing right now if I were on my own, right? So you kind of like try stuff out. Let's say I do this. Let me actually clear this. 505, 525. Right, so it's 11.25. I kind of like this trade, right? So I'm gonna put in a one lot for 11.25. This is in May, so I rolled it out a month, and I'm basically selling again the May 25s, which right now is only $3 of intrinsic and $20 of extrinsic, which is $20 worth of premium. So I like this kind of spread, right? So I'm going to send this order for 11. Let's actually do it for 11:30. No, 11:40. Right, looks like it's actually recovering a little bit here. But anyway, I'm going to put in 11:40, see what happens. You guys can mess around with the different lines, but you're basically scaling your call spread because your first ones work. So like the stock is actually down and the spread is working for me, right? So I have a bullish spread. Apple is lower than where I actually put this on and I made money, which is, hey, that's what you want, right? You want to make money when you're wrong, you want to make money when you're right, and you hopefully lose money only when you're really, really wrong. And that's why I like this ratio. So I'm just going to keep rolling, and hopefully like I'll just keep doubling up until like it has a really good time period where it has a massive increase, and then I'll roll out of it. So all the other stocks I've covered before a little bit here and there. So here's all my other trades. You know, it's pretty much straightforward. This RSX, maybe I should cover it real quick. I know I rolled it down because I was uncomfortable with the 23 put, even though the order flow was selling these, right? So I rolled it down to the 22, and now I feel a little bit better because, you know, it probably has another 5% before my 22 becomes in the money. So I'm doing that overall, and then I saw people do this trade, so I'm piggybacking that one as well. And if you look at the stats tab today, you see these 14,000 puts traded, and a lot of these are 255. You know, these I don't know, but these looks like they're selling puts. So they're buying premium, shorting puts. Maybe the whole thing with the standoff is not over yet, so we'll see what happens. Now, my biggest trade that I have right now, and you know, it's this. I have tons of positions in ZNGA, so you guys know what I was thinking. If you guys listen to my tape for the last 2 days, I've been talking about how I was thinking ZNGA was going to pull back down to 550 because of the order flow and because of this chart, right? So it doesn't really stay out of this weekly Bollinger too far. So I was hoping it pulled back to 550 at expiration, and I actually did that. And what I did was I actually positioned myself to make money if my assumption was correct. And so here you go. I sold this straddle, not all at once, just a little bit here and there. And now I have bids in there. So you see, working. You see my ZNGA. I have 2 cent bid on the calls, 1 cent bid on the puts. You know, not sure if I'm going to get filled until at the very end of the day. But whenever I see an opportunity to close it, I'll close. See how like this tick chart is telling me like it's kind of like it's not really moving anywhere. So my thinking is it'll actually get closer and closer to 550. So I might have a really good chance of actually closing this for a really low price. I also bought more of these for a penny just in case ZNGA did have some negative announcement today. So it was like a 1-day protection, and I paid penny for it. Let me see the risk chart right now. So it's only 1 day, so let me get rid of all these other lines. And so this is where I'm at now. So, you know, I pretty much sucked out all the premium of this, and then, you know, there isn't that much premium. So there's like 4 cents. So there's 3.5 value right now. That's 2.5 cents, maybe 200, 300 bucks here, and then there is 60 bucks here. But I also own a lot of options in the other months, which will decay over the weekend as well. So the biggest trade I did on that spread was this. I sold this. Let me actually pull it up. So you guys can see it. I sold this, the 5.5s, and I bought this, right? The April 6 calls, and I did it 4 or 5 cents, and now they're worth 20. So I made 20 cents. It's essentially the same as me buying these April 6 calls right now for 4 cents. The real question now for me is, what do I do for Monday, right? So if I look at the risk chart now, you see how it looks like I'm going to lose a ton, but that's because it's assuming that all this is going to turn into stock that are in the money. So I need to fake this out. All right, so let's say I bought these back. Let's say I bought these back and sold these out. So essentially, I've eliminated my March position that's going to go away after today. And let's look at the risk chart now. So it's actually completely opposite. I actually have an extremely bullish position right now, right? So if ZNGA goes up to around $6 on Monday, I should make $4 grand. But also, if it goes down 50 cents, I'm going to lose $3 grand. And let me actually do 25% out. And let's see what my max loss is. So my max loss is around $4 grand if I actually write this naked. So, you know, I was kind of messing around a little. Maybe the prudent thing is to sell some of these March 5 calls, right? Let's see how much of these are trading. Yeah, people are already selling these. Let me see the stats. 12,000 calls. Looks like the 2 biggest trades have been buying calls, and then you see some of these selling of the calls. But these are like little calls. So yeah, overall, I think it's still bullish. So it's like long. The net delta is long, and people are still buying. So, you know, maybe I'll just roll the dice and just keep it. Like and this is something that everybody who trades will have to make a decision on. This is the kind of decision that eventually it's like it's up to each individual trader on their risk parameter, right? So if you didn't really want to risk 4,000, you would actually I would buy those back, and I'm gonna ride it naked for the next couple of weeks, and hopefully next week it's gonna go to $6 again, right? So my whole premise is that it got suppressed because it ran out of this Bollinger Band, right? Weekly Bollinger Band, and so there was technical reason why there were more sellers than buyers, and also expiration, right? So the expiration, as I talked yesterday and explained, that the open interest doesn't mean anything except when there is nothing going on. So all these guys who own these options right now, looks like 10,000 on this line, which is far greater than any other line. What they're doing is they're scalping the stock down to 50. So right here, I'll be selling it at 551. I'll probably buy it at 549. I'll do that all day until basically it expires in a few hours or so. So let's say, like, okay, I'm gonna, you know, technically I can roll this into these, or technically I can roll them into these, right? So let's say I sell 100 of these. Let's see how that looks. Look at my risk chart. See how they're, so kind of stuff that I generally like, right? As the time goes, let's actually do next 6 weeks. Maybe it's a little too confusing. But as time goes, you see how this line is going up? Well, because if the stock doesn't move, I'm actually going to start making money because of the fact that I sold 100 of those. And you can see that I make far less it going forward. So if it goes to $6, I only make 1,000 instead of 4. And now if it really drops, my maximum downside is 2,200. Right, so that's kind of the decision I'm kind of having to make. I haven't made it yet. That's if I sold those. Let's say I'm like, you know what? I don't want to sell these. I'll sell these 135 times. Right. So essentially, what I'll be doing is if I get away with it next week, let's say on March 14 expiration, ZNGA trades shade below $6, which would be the ideal situation for me. I would have actually sold this for 4 cents, which originally I bought this spread for 4 cents. So I would be buying this for free. That's how I would be thinking, right? So let me fake this in for 135 times and see where my risk chart is. So as you can see, now I put this little hat right around the $6 range, and if it goes up to $6, you know, I make 2,200 instead of making 4, and if it goes down, I make, you know, I lose 34, which is, you know, almost $500 less. So it's not really that much more. So that's my choices right now. Ride it naked. Maybe sell the 5.5 calls or sell the 6 calls is what my options are. I'm not sure exactly which one I'm going to pick. I'm actually leaning, believe it or not, of not doing anything. So my thinking, my real thing is this. I want to do, this is the position I want. So I'm willing to risk the $4,000 that I could lose. And you know, I want the stock, I want to make the max if it goes up. Maybe one of the things I can do is maybe buy more puts, right? So if, let's say, like you're taking, you see this, it's only 3 cents. So let's say I bought 50 of these for 3 cents, and I spent $150 protecting myself. Basically, if this stock did go down, now my max loss is 2,500 next week, right? So I can actually, I can say, all right, 100's good, but you know what? I'm okay with spending $300, basically protecting myself for 1 week, right? So now I look at the risk chart, and there you go. Right now, my max loss is 1,700, which is not that bad, and my max gain, if I go here, it's still very close to what I would be making minus the $300 in premium I paid. So I think if I don't do anything, I'll probably buy these, right? So let me actually see what the market is on this. Right, it's 2 bid at 3, so I'm actually going to put in 100 for 2 cents. Maybe I'll get filled, maybe I won't. Most likely I won't get filled, but now I have it. So I'm going to actually, I modeled out the risk, and now I'm going to actually buy it. I'm going to execute it. So my risk chart is going to look like this because I'm going to artificially buy 100 of them. So let's just say I bought them. So I'm going to pay 3 cents, or hopefully I get filled at 2, but I'll pay 3 if I had to. And I zeroed out all these others, and now this is my risk chart, which I'm kind of liking because you know, my downside is 1,700, and my upside is pretty high. So if ZNGA does run next week to the $6 range, I can make 4,000 or 5,000, and I can protect 2,200 of my downside by spending $300, and it might not be a bad idea. And in Monday, if it doesn't look like it's going to run, maybe I can sell some of these March 5.5 straddle. See how that's like about 32 cents right now, fair value. So you can maybe sell that for 28 cents, 29 cents, and pay for this 300. You only have to sell 10 lot to get $300 worth of premium. So you might be wanting to do that. So sometimes when I buy pay 150 for these, you sell 7 or 8 of these straddles, and you'll actually pay for this put. So that's a comprehensive look at how I use this product. It's tremendously powerful. I'm shocked that people actually trade without this information when I actually started using other people's platform. And yeah, they have some cool stuff in there that's pretty useful, but I mean, essentially not knowing volatility and order flow information, which is the two most important thing, other than stuff that you can pretty much research on the web or look, use like stock charts to get. Like they're all readily available, right? But this stuff is not readily available, and people don't even have that on their trading platform, which is crazy. It's like driving without side windows, or like driving with one eye closed. You're actually not seeing half of the facts when making trading decisions, which I think puts you at a huge disadvantage against a professional like bank or something when they already have more research anyway. So for those of you guys who want to try this on, try the LVX, go to livevol.com, click on LVX, and then just click on free trial. And believe me, it's going to be like night and day of what you guys can do using this platform. It's so far beyond versus other products. It's you can't even compare, right? In my opinion, that's just me. But obviously I built this product and I use it. I love it, and I hope to kind of have you guys on every day. And as you guys see me doing live trades and seeing how and why I do it, it's like a combination of everything. But a lot of it, half of that combination is order flow and volatility. The other half is technical, fundamental, the whole market, which way it's trending. So it's important that you have all these factors at your fingertips to make the best decision possible. So hopefully I'll see you guys tomorrow, and see you guys later. Take care.